Hey guys, welcome back to my channel where we simplify options trading for you. If you're looking to learn a new skill set or expand your trading knowledge, you've come to the right place. This video marks episode 2 of the options trading series for beginners. Today, I'll be covering the 5 things I wish I knew before I started options trading. Before we get started, let me give you a quick overview of what we'll cover. Number 1, the importance of risk management. Number 2, understanding the Greeks. Number 3, the complexity and learning curve of options trading. Number 4, the need for patience and discipline. Number 5, setting realistic expectations. Stay with me to the end because these tips could be all the difference in your trading journey. And as always, if you find this content helpful, make sure to give this video a thumbs up, share it with your friends, and subscribe to my channel. I have a lot more valuable content on the way, and you won't want to miss it. Alright, let's dive into the first thing I wish I knew as a beginner options trader, the importance of risk management. Understanding how to manage your risk is the foundation of successful trading. Managing risk is crucial in options trading. It involves setting stop-loss orders, determining position sizes, and never investing more than you can afford to lose. Proper risk management can protect your capital and ensure long-term success. In options trading, every decision you make involves a certain level of risk. It is important to understand that risk is inherent in the market, and your goal should be to manage it effectively to protect your capital. Here are some essential risk management strategies I wish I knew as a beginner. Number 1, set stop-loss orders. Stop-loss orders are designed to limit an investor's loss on a position. By setting a stop-loss, you determine a price at which you'll exit the trade to prevent further losses if the trade goes against you. Number 2, determine position sizes. Never invest more than you can afford to lose. Position sizing involves determining the amount of capital to allocate to a particular trade based on your risk tolerance. Number 3, diversify your trades. Spread your risk, diversifying your trades across different assets and strategies. This way, a loss in one trade can be offset by gains in another. Number 4, have a plan for potential losses. Always plan for the worst case scenario. Know your exit points before you enter the trade and stick to them regardless of your emotions. Guys, this is going to be key to your trading. Let's take a closer look at stop-loss orders and position sizing. Setting a stop-loss order helps you cut your losses and protect your capital. For an example, if you buy an option at $5, you might set a stop loss at $4 to limit your loss to $1 per option. Position sizing is equally important. If you have a $10,000 trading account and you're willing to risk 2% on a single trade, that means you're risking $200. If the option price is $5, you should buy no more than 40 contracts. That's $200 divided by 5 equals 40 contracts. Diversifying your trades can help you manage risk by spreading your investments across various assets and strategies. This way, you're not putting all your eggs in one basket. Now, let's look at the second thing I wish I knew before I started trading options: understanding the Greeks. The Greeks are essential for assessing risk and making informed decisions. They help you understand how market movements affect your options position. There are 4 main Greeks: delta, gamma, theta, and vega. Let's break down each one. First, let's talk about delta. Delta measures sensitivity of an option's price to changes in the price of the underlying asset. It represents the expected change in the option's price for a dollar change in the underlying asset's price. For an example, if the call option has a delta of 0.5, it means that for every dollar increase in the stock price, the option's price is expected to increase by 50 cents. Delta value range from 0 to 1 for call options and from 0 to -1 for put options. Understanding delta helps you gauge how much your option will move relative to the underlying asset. Next, let's look at gamma. Gamma measures the rate of change of delta. For an example, if an option has a gamma of 0.05 and the stock price moves by $1, the delta will change by 0.05. Gamma is highest for at the money options and decreases for in the money and out of the money options. Now let's take a look at theta. Theta measures time decay of an option. For an example, if an option has a theta of negative 0.02, its price would decrease by 2 cents each day. Theta is a critical Greek for understanding time decay, which can erode the value of options over time, especially for short-term options. Lastly, let's discuss Vega. Vega measures the sensitivity of an option's price to changes in implied volatility. It indicates how much an option's price would change for a 1% change in implied volatility. For instance, if an option has a Vega of 0.10 and implied volatility increases by 1%, the option's price will increase by 10 cents. Vega is crucial to understanding how volatility affects options pricing, particularly for options with longer time horizons. Out of all the Greeks, I typically only care about the delta and theta. If you guys have any questions about Greeks or options trading, leave a comment below. Also, if you're finding this content helpful, please give this video a thumbs up and subscribe to my channel for more insights. Let's move on to the third thing I wish I knew before I started options trading: the complexity and learning curve of options trading. So far, we've covered risk management and the Greeks. Now let's talk about the complexity and learning curve of options trading. Let's break down what makes options trading so complex and how you can overcome these challenges. First, let's look at the different components that contribute to the complexity of options trading. There are several key factors to consider. Number one, various strategies. Options trading offers a wide range of strategies, from basic calls and puts to complex spreads and combinations. Then you have to deal with the terminology. It can seem very scary at first. The language of options trading includes many specific terms like strike price, expiration, premiums, and intrinsic value. Then you got all these different market dynamics. Option prices are influenced by multiple factors, including the price of the underlying asset, volatility, time decay, and interest rates. All right, guys, so here are a few learning resources that you can utilize to take your options trading from 0 to 100 in a reasonable amount of time. You want to start with some books, some websites, you want to take some courses, and you want to paper trade to practice your strategies. Some books you might want to take a look at is Strategic Investment by Lawrence McMillan, The Options Playbook by Brian Overby. You want to go, just search the web. They have free content all over. Investopedia, Options Alpha. You can also take courses, Udemy, Coursera. You can find your favorite YouTuber. They might be selling the course. You can buy a course from them. And once you guys get set up, make sure you paper trade to practice your strategies. Education and practice are key. I want you guys to start with the basics, gradually build your knowledge and experience. Don't rush into learning the process. Take time to understand each concept thoroughly. You want to consume as much information on the topics each day. It doesn't have to be overcomplicated. 30 minutes to an hour a day studying either YouTube, online outlets, or you can just join my Discord channel. See the link in the description below for more information. Now, let's look at the fourth thing I wish I knew before I started options trading: patience and discipline. First, let's talk about patience. In the fast-paced world of options trading, it's easy to feel pressured to make quick decisions. However, successful trading often requires waiting for the right opportunities. Patience means waiting for the setups that align with your trading plan and criteria. It involves resisting the urge to enter trades based on emotions or market noise. Instead, focus on quality over quantity. Consider this example. Suppose you have identified a particular setup in your trading strategy that has a high probability of success. Instead of jumping into the market at any sign of movement, you wait patiently. for all your criteria to be met. This approach not only increases your chances of success, but also reduces the risk of impulsive and potentially costly mistakes. Now, let's dive into discipline. Discipline in trading means sticking to your trading plan and following your rules consistently, even when it's challenging. Discipline involves setting clear rules for entry and exit, managing your risk effectively, and not deviating from your strategy based on emotions. Notice I keep bringing up this word emotions because that's going to come up a lot through your trading journey. It's about making rational decisions based on your plan, not the market's unpredictability. Here's an example. Imagine you have a rule to never risk more than 2% of your trading capital on a single trade. One day, you come across an opportunity that seems exceptionally promising, and you're tempted to risk more. However, exercising discipline means sticking to your rule, even if it means missing out on a potential gain. This consistency helps protect your capital and ensures long-term success. Patience and discipline continue. So you want to make sure you follow a well-defined trading plan. Avoid making impulsive decisions based on fear or greed. You want to take breaks to prevent emotional fatigue. And you want to make sure you guys are reviewing and learning from each trade. Both patience and discipline can be challenging to maintain, especially in a volatile market. Let's look at some common challenges traders face and how to overcome them. Number one, emotional trading. One of the biggest challenges is managing emotions like fear and greed. To overcome this, develop a trading plan and stick to it. Use tools like stop loss orders to automate your risk management. Number two, overtrading. The temptation to trade frequently can lead to poor decision making. To counter this, focus on high quality setups and avoid the urge to consistently be active in the market. Number three, impatience. Waiting for the right opportunity can be tough. Practice mindfulness and remind yourself of the benefits of waiting for optimal setups. Developing patience and discipline takes time and practice. Here are some practical tips to help you cultivate these qualities. You want to create a trading plan. Outline your strategies, risk management rules, and criteria for entering and exiting trades. Having a plan reduces impulsive decisions. Next, you want to keep a trading journal. Document your trades, including your reasoning and emotions at the time. Reviewing your journal can help identify patterns and improve your discipline. Then, you want to set realistic goals. Focus on achievable and incremental goals rather than aiming for unrealistic profits. This helps manage expectations and reduce the pressure to overtrade. Then, there's nothing wrong with taking breaks. Avoid burnout by taking regular breaks from trading. Step away from the screen. Go ahead and clear your mind. Come back with a fresh perspective. And last but not least, you guys want to make sure you learn from your mistakes. Using losses as learning opportunities. Analyze what went wrong, how you can improve. This reflective practice builds discipline and resilience. The last thing I wish I knew before I started options trading is setting realistic expectations. Options trading is not a get-rich-quick scheme. I say again, options trading is not a get-rich-quick scheme. It requires time, practice, and continuous learning. Setting realistic goals and focusing on that steady growth is essential. Unrealistic expectations can lead to disappointment, poor decision-making, and substantial losses. If you guys set realistic expectations, on the other hand, it can help you stay grounded and you can focus on steady progress. Now, to the left and to the right of this screen, you have some unrealistic expectations on your left and some realistic expectations on your right. So let's start with some unrealistic expectations. Believing you can double your account in a short amount of period. Unrealistic. Expecting every trade to be a winner. Unrealistic. Thinking you can quickly master all trading strategies. Again, also unrealistic. Now let's look at some realistic expectations right here on the left. Aiming for consistent small gains. That's realistic. Understanding that losses are a part of trading. Also, that's realistic. Being patient with your learning process and progress. Again, guys, this will be considered realistic, setting realistic expectations. That wraps up the 5 things I wish I knew before I started options trading. I hope you found this video helpful. Remember, the journey to becoming a successful options trader is a marathon, not a sprint. Consistency, discipline, and a commitment to continuous improvement are the keys to long-term success. If you enjoyed this video, please give it a thumbs up and share it with your friends who might find it useful. And don't forget to subscribe to my channel for more in-depth tutorials and tips on options trading and investing. Thanks for watching and happy trading. See you in the next video.
I need that money.